Joining me now, Zach Pandl, Head of Research at Grayscale. Zach, thanks so much for being here.
It's my pleasure. Great to see you.
So we're here to talk about the ETF. It's the Grayscale CoinDesk Crypto 5 ETF, sort of a milestone for the crypto world because it's the first multi-asset crypto ETP, I guess we can call it. It consists of what? Bitcoin, Ethereum, XRP, Cardano,
and Solana.
And tell us just, I guess, to start, give us a quick 101 of what we need to know about each of the 5 holdings.
Yeah, great question. People are getting familiar with Bitcoin, which is a sort of digital gold use case, a store of value, digital asset, but there's lots of other applications of blockchain technology, and that's what many of the other assets in this product are doing. So things like stablecoins, things like tokenization, decentralized finance, for investors that want exposure to those ideas beyond digital gold, this is the type of thing that this product offers.
It's interesting because it seems like although Bitcoin, to your point, is the most recognized still, it seems like there's some diversification going on. What does that tell you about overall crypto sentiment and where we are in the space?
Well, crypto is growing up in all kinds of different ways, and that's both on the investment product side of things, the ability for fund managers like ourselves to offer index-based approaches to investing, which are very popular and common in all other asset classes, stocks, bonds, et cetera. And it's also in the applications of the technology. Stable coins coming to Wall Street, coming to mainstream finance with a comprehensive regulatory framework, for example. So this technology has been around for 15, 16 years, and it had a slow start, but now is really going mainstream in lots of different ways. And I think that process is going to continue over the next 5, 10, 20 years. And these types of products, these types of ETFs are a way for investors to capture that trend over time.
Talk to me about the benefit of investing in GDLC versus just buying Bitcoin, Ethereum, XRP outright.
Yeah, of course. When people approach the stock market, some people want to be stock pickers and decide which one of the 500, say, is going to be the best performing. Other people just want exposure to the asset class, exposure to the beta. And so an index approach that rebalances over time, that follows a transparent index, is a very successful way to access these markets. And the same is true in crypto. People don't want to be coin pickers necessarily. There is a lot of complexity to blockchain technology. They just want to capture the opportunity, capture the trend over time, the beta of the asset class. And this product, the Grayscale CoinDesk Crypto 5 ETF, is a great way to do that. We've been running this product since 2018 as a private investment vehicle. We're thrilled to be able to offer it to many more investors as an ETF.
But it's important to note that GDLC doesn't actually have the same protections as a normal ETF. So talk to me a bit more about the trade-off between the access but also the risk.
Well, the biggest risk for crypto investing is the same as everything else. It's just market risk. This technology has been around a long time, and there'll be adoption cycles and phases of success and phases where there are setbacks, just like in everything else, whether it's quantum computing or biotech or anything else. But the market risk, the ups and downs of the asset, that's the biggest concern that investors should have, and they should be aware of the volatility and always put these things in the context of a broader portfolio.
Does bringing multiple, 5 in this case, digital assets under one wrapper actually mitigate some of the volatility, or does it concentrate the risk?
It'll mitigate the volatility to a degree in the same way that diversification helps in any type of asset allocation. But the biggest thing is that you're diversifying across the use cases of the technology. Bitcoin really has this digital gold use case, a macro asset, what brings someone like myself that focuses on macroeconomics into the crypto asset class. But as I said, there's so many other things going on, like tokenized assets, tokenization, and we want to get exposure to those things as well and kind of spread our assets around within crypto. So that same principle of diversification that works in other asset classes can absolutely be applied to crypto.
How should investors be thinking about things like the government shutdown and tariffs as it relates to crypto? Because despite those things, we've seen the equity market power to all-time highs. Crypto has been doing pretty well as well. But how should they be factoring in potential headwinds like those?
Yeah, the crypto asset class is becoming a part of mainstream finance, and that's great for where these assets and where the technology, blockchain technology, is going over the longer run. But it also means that the asset class is affected by some of the same macro risk things that affect stocks and currencies or anything else. So shutdowns, tariffs, the emerging kind of pressures in lending markets and credit markets, for example, all of these things can spill over into investor risk appetite and therefore into crypto, even though the technology and the trends that are driving it from a fundamental standpoint are completely different. So these are just the types of things that investors need to be aware of when they're managing their broader portfolios. They need to think about this with crypto. But the broader trend is about adoption of this technology, adoption of public blockchain technology, and what we're providing is a way to access this through ETF type products.
Regulation is also still a wild card, still a bit of uncertainty around there. What's the next big policy decision that you're waiting for that could either expand the market and help it really take off, or that could potentially constrain it?
Yeah, absolutely. We've seen a lot of change already this year, and there's more to come. President Trump came to office with a mandate from voters to bring regulatory clarity to the crypto asset class, and has really been delivering on that, both from at an agency level, regulatory agency level, and in terms of bipartisan legislation. We had the Genius Act in July on stablecoins, and now a bipartisan group of senators is working on the next phase, what we call in the crypto industry the market structure bill. And this will touch lots of different aspects of the industry. I would love to see that done by the end of this year. I think maybe more like the first quarter of next year. But this is another big piece of regulation. And this is going to help deepen Wall Street's and commercial banks' access and integration with blockchain technology. So that'll be the next major thing to watch. Watch this space. Senate is actively working on it to now.
Okay, just final thoughts for investors. What's your best piece of advice for them as they think about maybe allocating some of their portfolio to crypto?
Yeah, I'd say don't miss the bigger opportunity. There are lots of particular things going on and lots of things to learn about the assets and blockchain technology. But this is a beta opportunity, an emerging asset class, and you don't want to miss the boat in some broader way. So diversified exposures like our GDLC product are a great way to build that into your portfolio, and a little goes a long way. You know, this is about building a diversifier into a broader portfolio with stocks, bonds, and other alternatives, and we think it's a great way to go.
Still 1 to 5% of the portfolio. That used to be the kind of the crypto allocation. Is it getting
we say
bigger now?
5% plus or minus, depending on the investors, but we work closely with financial advisors on helping them tailor that recommendation to all their specific client needs.
Okay. Zach, thank you so much for sharing insights on GDLC.
My pleasure. Thank you.
That's Zach Pandl, Head of Research at Grayscale.